Thanks a lot for the invitation. I'm very honored to be on this panel with such a high-quality speaker, so thanks again. I don't know whether I'm Slovak Hans-Werner Zinn, Professor Zinn. I take it as a compliment, even though I would probably argue with him as well, on some points at least. Let's see, where are we now? We are fighting a monetary fight in the eurozone. Mr. Draghi, he's going, or he has already spoken probably, but let's see what he said last times, like we will do everything it takes, we won't give up, and so we are fighting, like he's fighting as well. And I don't know whether you know, but we just celebrated round number 1 trillion of newly printed euros this week in our kind of quantitative easing program. And this is quite a nice parallel, like what's happening in the eurozone, like confetti money is falling on the economy, and the entrepreneurs and the agents, economic agents, are quite scared. How does 1 trillion on a ECB balance sheet look like? Like this. This is where the quantitative easing started, and they just printed the trillion and bought mainly government bonds. Did it work? Like, this is the theory how it should have worked. Like, you just print the money, give it to banks. Some of it flows back to the states, like to the government, so they don't have to. They don't need that much money for refinancing of their debt, and at the same time, somehow the economy will start to grow like faster. Some of the money flows to the companies, which then invest the money and hire people, and we have increase in employment rates and in investment. Well, that was the theory. It doesn't work like that. Well, at least I think they had a theory. It wasn't quite voodoo, like it was a wrong theory in my opinion, but they had a theory. Some of the banks are scared, well, like Italian banks and some other banks, so they keep the money and don't really want to invest into some risky private business. They rather buy state bonds. So we have hoarders, banks as hoarders. So you can see that the loans to private sector, this is the beginning of QE in the Europe, are the same. Like we printed 1 billion, or 1 trillion in Slovak, it's billion, sorry for my English, 1 trillion euros, and it didn't really change. Like the companies still have the same amount of loans on their balance sheets. What has changed? Well, 1 trillion is a lot of money. Like if you calculate it, it's around 20% of whole tax revenue of the whole eurozone. Like 20%, they just printed it. Or it's 3,000 euros per eurozone citizen. So it's quite a lot of money. And you could see this effect in Slovakia. Like the companies don't really borrow that much. This is 2008, this is 2015, and you don't see really a difference. What you can see is that ECB was very successful in fooling households, fooling small consumers, because like they believe what they see, they believe that the low interest rates will last. They are here forever, aren't they? So they just really maxed up their credits, like mainly mortgages, and you can see now in Slovakia, the households have 2 times more debt than they had in 2008. So this is what was achieved with the ECB monetary policy. There is no inflation, I'm being told. I have heard this story also in years 2003 and 2004 from Alan Greenspan. He didn't see any inflation. Why? Because like he was looking at the wrong numbers. He was looking at just GDP, like consumer spending and consumer prices. And these numbers were distorted by China, what was going on in Asia, by the productivity spurt in Asia. He didn't look at the housing prices, he didn't look at the stock market and the bond market, and we can see, I can see inflation. If you look at the American stocks, you can see that they grew by over 300% from the year 2009. If you look at what are the central banks doing right now? They are still printing a lot of money, even though the Fed is on hold. Like, we are now waiting whether the Yellen will continue with the rate increases. Other central banks like ours, like ECB or Bank of Japan, are printing still a lot of money. And if you compare the intensity of money printing with the past years, you can see that we are somewhere around like what was happening in 2009. There are around $200 billion printed every month. And you can see a nice correlation of newly printed money with what's happening on the stock markets. Like, so you can see that the new money flew into the stock markets, into the bond markets, which are, by the way, the biggest markets in the world. Like, the amount of American GDP is traded in like a couple of days on the bond markets. So you cannot really leave out these huge markets if you want to say what's happening with the prices in the economy. Another effect of these policies, and it's not just the ECB, it's also other central banks around the world, is that everybody is looking for the riskless return, but what we get is no return with risk, like risk without the return. If you compare how you could get 7.5% in the United States in '95, and back then you just had to buy some bonds. Right now you have to buy private equity, real estate, non-US equity market. So we have a lot of risks and not much of a return. And I think if the money printing stops, because like sometime it has to stop because inflation will come, then we will be very surprised like about the pricing of various risk assets. I will skip this chart so I can keep my time. Another effect what is ECB doing is like very pleasant for the governments. Like I just picked up Italy as well because it's such a nice country, at the same time such a huge debt, which if something goes wrong in Italy it will influence the whole financial system. And as you can see, like from the year 2012, these are the yields on 10 years Italian bonds. It fell from almost 8% down to 1.5, and this is the real effect of the struggles of ECB. I think this was intended, but like nobody expected that it will go as far. That Italy, that has growing debts, it has still growing debt, and we were afraid in 2012 that Italy will go bankrupt. Like Mr. Trichet changed Berlusconi into Monti, and like they started to buy Italian bonds, so Italy doesn't have real problems with refinancing. But since then the debt grew, and at the same time the interest rates went down, and this is, in my opinion, the main effect of expansionary monetary policy in eurozone. Well, Fed is doing its part as well. We see these all central bankers like pushing the interest rates down, and other central banks as well. Right now, the main central banks are owning assets at almost like 40% of GDP, and it's quite the record. And what will happen if they just try to sell the assets that they bought? Well, I don't know, but I think the prices of some of them will go down. And this is the answer to the question in the title of my talk. Like, I think the biggest bubble is here. Like, it's in interest rates. These are the US interest rates for over 100 years, and we are right now at the historical lowest levels. So we just did a record, and nobody knows what will happen. Many countries have like interest rates that are already negative, and what will happen? Well, we knew before. Like, that's a quite old theory. We know that if you subsidize interest rates by the way of printing money, you create bubbles. Like, we knew it in 1912. This is from a leaflet that was warning US citizens before Fed introduction, and we know that central bank that just can blow bubbles through creation of credit. At the same time, we have like the growth of developed countries is slowing down. Like, you can see this is like 10 years moving average of the main developed countries, and it's going down. What is interesting that the eurozone is growing even slower than Japan. Can you imagine? Like the Japan lost 2 decades in Japan, and right now the eurozone is even worse. And one can wonder what will happen next, like whether we will go below the zero. If we go, it means that the capitalistic system cannot support so much debt anymore. And this would be like disastrous in my opinion. Why is there no inflation in consumer prices? Well, Hayek said that if you pour money into the system, it's not like water. It's like honey. Like first there is a bump. Because it takes time till the new money works itself out into the all prices in the economy. So in my opinion, we are just seeing a bump in capital markets, in stocks and bonds, and the money will flow into consumer prices. It's just a matter of time. I don't know whether it will happen in 1 year, 2 years. Maybe it will happen next year, because like if the price of oil found its bottom, maybe the prices will start to increase and incorporate further increases in the price of oil. This is our main problem. Right now, this is the biggest bubble. We have too much debt, and nobody knows what to do with it. So it's okay, well, if what we lived through in 2007, 2009 was a debt crisis, now we are even in bigger trouble because we have more debt. So what will happen if the interest rates go up? I don't know. I think many states will go bankrupt. I think the central banks will try to suck up the debts, at least part of it. I think there will be financial repression going on, like forcing higher rates of inflation on you, and at the same time paying you less interest. And let me close by the most important chart in Eurozone. This is the chart of public finance of France. And the question for the euro, for the future of euro, is like, who can force France to balance its budget? We have hoped that the Stability and Growth Pact will do it. It didn't. We have hoped that Fiscal Compact will do it. It didn't. And if you, because like in the Eurozone right now we have a tragedy of the commons, because like what do you describe, Professor Keber, is like we are using the central bank as a fiscal institution that has unlimited money. Okay, we can do it for some time. If you have deflationary pressures, you can do it because you don't see it in the prices. People don't see it in the prices. But there is a limit. And if we find the limit, then we will see that any larger deficits will lead to higher prices, to higher inflation. And if we cannot force member states into fiscal discipline, we cannot believe that in the long term the Eurozone or the euro can survive. And that's why I think that the euro is, as a currency, is doomed in a perspective of 10 or 20 years.